It's Tuesday, 20th of January, 2026. Welcome back to your news update on blip brief, crisp, but almost everything updated every weekday.
Today is one of those days where you really have to look at the map to understand the money. We are seeing a massive divergence in the global narrative.
A divergence how?
Well, on one side, you have the Western Hemisphere sort of locked in this weird paralysis of tariffs and trade anxiety. And on the other, you have the Indian domestic engine just ignoring the noise and accelerating.
Ignoring the noise is putting it mildly. The numbers coming out of the IMF, the International Monetary Fund, they aren't just good, they're head-turning.
They really are. The IMF just updated their fiscal year 26 growth estimates for India, and they didn't just nudge it up, they hiked it by 70 basis points.
70 basis points.
They're now projecting 7.3% growth.
7.3%. Okay, for context, in a global economy that's, struggling to find 2 or 3%, that is a massive outlier. But I have to play devil's advocate here.
Go for it.
70 basis points is a huge revision for an institution as conservative as the IMF. Did they just get their math wrong the first time, or did something fundamentally change on the ground?
It's less about bad math and more about a surprise in consumer behavior.
Okay.
The Q3 performance just blew past all the estimates.
Okay, but why?
If you peel back the layers, the IMF is pointing a finger directly at policy. Specifically, the GST rationalization we saw back in September.
The tax tweaks, at the time it felt almost like administrative cleanup, just shuffling papers.
Right, simplifying brackets, reducing rates on certain consumer durables. But the transmission of that policy into the real economy was faster than anyone modeled. It lowered end prices on the shelf, which immediately unlocked disposable income.
So this wasn't just rich people buying stocks, this was real consumption.
Exactly. It fueled robust domestic demand. And this is the key takeaway, really. India is effectively decoupling. While the U.S. and Europe are worrying about export tariffs,
All that external noise.
India's growth is being powered by people inside the country, buying things made inside the country. It's an internal combustion engine that doesn't need nearly as much foreign fuel as it used to.
Which is a massive strategic advantage when the geopolitical weather outside is getting stormy. But let's talk about that storminess in the markets.
Yeah, it was a sea of red for Asian stocks and U.S. treasuries. That tariff angst is back.
But looking at the Indian ticker tape, it was a bit schizophrenic, wasn't it?
Schizophrenic is the perfect word. The broader market was nervous, sure. But we saw some violent moves in individual stocks that had nothing to do with Trump or Greenland and everything to do with the expectations game.
Let's start with the carnage then, the IT sector. Wipro took a beating.
A beating is right, down over 8% in a single session. For a blue-chip behemoth, that is a crash.
But here's what I don't get. We know the global environment is tough. Was their Q3 report really that bad, or is the market just overreacting?
Well, that's the thing. The Q3 numbers were lukewarm, but this wasn't an earnings crash. This was a guidance shock.
Break that down for us. Why does guidance matter more than the money they actually made?
Because markets are forward-looking machines. They don't care what you earned yesterday. They care what you're going to earn tomorrow. Wipro essentially came out and said, we aren't sure where the next check is coming from.
Ouch.
They gave a really bleak outlook for Q4.
So when a major outsourcer says we don't see the demand, investors just assume the worst, that the deal pipeline is drying up.
Precisely. It signals hesitation from clients, and the big question is this a Wipro problem or an industry problem? That fear spreads.
And that's different from what happened with Reliance.
Very different. Contrast that with Reliance Industries, or RIL. They were down over 3%. 3.09% to be exact, but that was a traditional earnings miss. Their businesses just grew slower than expected.
So Wipro was fear of the future, Reliance was disappointment with the present.
You've got it. And Tata Motors got dragged down too, sliding about 2.8%.
But let's look at the flip side. We had some clear winners, and one of them is a bit of a paradox. Indigo. Shares jumped over 4%.
Yeah, their highest single-day gain in 16 months.
But didn't they just get fined by the DGCA?
This is my favorite dynamic in finance. The bad news was good news paradox.
Explain that logic. How is a penalty a reason to buy?
Because the market is an imagination machine. Investors knew the penalty for those mass flight cancellations was coming. In their heads, they priced in a catastrophe. Huge fines, maybe operational restrictions, grounded fleets.
They were bracing for a knockout punch.
Exactly. But when the actual penalty was announced, it was just a slap on the wrist. The uncertainty vanished, the cost was manageable, and the stock rallied because the reality was so much better than the nightmare they'd imagined.
So the 4% jump was just a sigh of relief in chart form.
Pretty much. And interestingly, despite Wipro's crash, Not all IT was suffering. Tech Mahindra was actually up roughly 2.4%.
Which flies in the face of the sector slowdown narrative.
It adds nuance to it. Tech Mahindra reported strong deal value in Q3. Their order pipeline looks robust.
So the money is still there.
It suggests that clients are still spending on tech, but they're being highly selective about who they spend it with. It's becoming a winner-takes-all market.
We also saw gains in consumer goods and banking. Hindustan Unilever up 2.29%, Maruti Suzuki up 2.08%.
And Kotak Mahindra Bank climbed 2.00%, which circles right back to our opening point about the IMF upgrade.
The domestic story.
Exactly. FMCG, auto, and banking. These are the direct proxies for the domestic economy. If the IMF says domestic demand is strong, these are the stocks that prove it.
Moving on to the corporate radar, we have some massive moves happening in the boardroom. Sun Pharma is making headlines with what looks like its boldest global bet ever.
This is a major strategic play. Sun Pharma has made a non-binding offer to acquire U.S.-based Organon.
Just another merger?
No, this is a calculated strike to dominate a very specific vertical.
And what's the target here? What does Organon have that Sun wants?
Women's health, biopharma, and biosimilars.
Biosimilars, we hear that term a lot. Is that just a fancy word for generics?
It's like the advanced placement version of generics. A generic drug is a chemical copy. A biosimilar is a copy of a biological drug, something made from living organisms. It's incredibly hard to manufacture and regulate.
So the barrier to entry is higher?
Much higher. And because it's harder, the margins are higher and the competition is lower. Sun is trying to escape the rat race of cheap pills and move up the value chain.
They want to own the high-value therapies in the U.S. market.
That's the play.
Speaking of high value, the IPO market is heating up again, and the big one everyone is watching is Geoplatforms.
The ball is officially rolling. They've shortlisted Morgan Stanley and Goldman Sachs as lead bankers.
A public float of that size changes everything.
It changes the liquidity dynamics of the entire market. It's one of the most anticipated listings in years.
And in the logistics space, Shadowfax Technologies is also queuing up.
They are planning a significant IPO to fund expansion and notably to cover lease payments. But there is a detail in their filing that potential investors really need to watch.
What's the catch?
Revenue concentration. They are heavily reliant on a single client.
The all eggs in one basket problem.
And in the logistics game, if that one client sneezes or decides to build their own delivery fleet, your entire business catches a cold. It's a classic risk factor.
Let's touch on banking again. PNB Punjab National Bank posted a record Q3 profit, up 13% year on year. That's like a victory lap.
On the surface, yes. Profitability is up. But if you look under the hood at the broader banking sector, there's a trend that's keeping bankers awake at night.
Okay, what is it?
The Canso ratio is declining.
Okay, Sansos, current account savings account. This is the money sitting in my bank account earning basically zero interest, right?
Correct. For a bank, that is cheap fuel. They take your idle money, pay you peanuts for it, and then lend it out at 8 or 9%. That spread is their profit.
And you're saying that pool of cheap money is drawing up.
It's shrinking. Why? Because the Indian saver is becoming an investor. They're realizing, why leave this cash idle when I can put it in a liquid fund or the market? As money moves from savings accounts to high-yield instruments, banks lose their cheap funding.
So to keep lending, banks have to pay more to attract deposits, which eats into their profits.
Exactly. The financialization of savings is great for the individual, but it's a headache for traditional banking margins.
That is a crucial structural shift. Now, we have to talk about the story that feels like it was ripped from a satirical novel but is having very real economic consequences.
The Greenland tariff row.
It is surreal.
If you wrote this in a movie script, it would be rejected for being too absurd. But the market impact is deadly serious. We're looking at a situation where real estate ambitions are driving trade wars.
So lay it out for us. President Trump is threatening tariffs on European nations, and the reason is explicitly linked to Greenland.
It appears so. The president has expressed a desire to purchase Greenland. He also mentioned a perceived snub regarding the Nobel Peace Prize, stating he no longer thinks purely of peace.
And because Denmark, which Greenland is an autonomous territory of, isn't interested in selling, we get tariffs.
That is the leverage being applied. But it's spilling over. The threat isn't just against Europe. Trump has threatened to reimpose a 50% tax on India the next day if courts halt other tariffs.
50%? That is an aggressive number. That shuts down trade.
It's a punitive number designed to shock. And we are already seeing action. Tariffs of 25% have been imposed on semiconductors.
Let's pause there. Semiconductors are in everything. If you tax chips, you aren't just taxing tech companies.
You're taxing the entire global economy. This disrupts supply chains for everything from cars to toasters to medical devices. It's an inflationary tax on modern life.
And yet, amidst all this, China seems to be holding its ground.
China's economy expanded by 5% in 2025. Despite the tariff barriers, their exports remain strong. It shows that global supply chains are sticky. You can't just switch them off overnight.
And what's the diplomatic situation?
Well, the tension is palpable. Trump is set to speak at the World Economic Forum in Davos on January 21st.
I assume the Danish delegation will be front and center.
Quite the opposite. Danish officials are skipping the event entirely due to the Greenland dispute. It's a full diplomatic boycott.
This uncertainty is triggering a rush to safety, which brings us to commodities. Gold and silver are having a moment.
They certainly are. Gold's up by 1.81%. But the real story is silver. It has crossed a historic psychological mark. We are seeing it at its highest ever levels.
Is this purely the fear factor?
It's the perfect storm of both. You have the fear factor underpinned by this geopolitical leverage. When you hear about 50% tariffs, you buy hard assets. But you also have industrial demand, which we'll touch on in a minute.
And there's a corporate beneficiary right here in India.
Hindustan Zinc. They just clocked their highest ever profit. And they rode this silver rally specifically. It's a perfect example of how global macro turbulence translates directly into a company's bottom line in India.
Now, speaking of silver, here's where it gets really interesting. Let's pivot to our innovation spotlight.
This is a brilliant piece of engineering coming out of Stanford.
We usually think of silver as jewelry, or as we just discussed, a financial hedge. But it might be the key to the next generation of electric vehicles.
To understand it, we have to understand the holy grail of EVs, the solid-state battery.
We hear this term all the time, solid state. It promises massive range, super fast charging, but we don't see them on the roads. Why?
Because they break.
Yeah.
Literally, in a solid-state battery, you replace the liquid inside a normal battery with a solid ceramic core. It's safer, holds way more energy. But ceramic has a fatal flaw.
It's brittle, like a dinner plate.
Exactly. Imagine a ceramic plate. Now imagine that plate expanding and contracting slightly every time you charge your car. Eventually, under that stress, it develops microscopic cracks. And then it's over.
Once those cracks appear, the battery shorts out and dies. It's a mechanical failure problem.
So it works in the lab, but it can't handle the daily grind.
Until now. The Stanford team decided to introduce, you guessed it, silver. But not just a chunk of silver. They create a nanoscale silver treatment that sits on that ceramic honeycomb.
Okay, but silver is a metal. How does it stop a crack?
Think of it like a living bridge. When a crack starts to form in the ceramic, the silver treatment effectively flows into the gap and bridges the circuit. It conducts electricity across the break.
So it heals the wound.
It does.
That is wild. So it's like a self-healing tire, but for the electron flow inside the battery.
That's a great analogy. It keeps the battery operational even when the ceramic is under stress. And the implications are huge. If you solve the cracking problem, you unlock batteries that charge in minutes, not hours, and last for hundreds of thousands of miles. It is ironic, isn't it? We usually think of innovation as moving away from old-school mining, but here we are, silver, one of the oldest currencies in human history, unlocking the futuristic technology of 2026.
It just goes to show sometimes the answer isn't a new element, but a new way of looking at an old one.
A perfect note to end on. From the macro shifts of the IMF to the micro cracks in a battery, everything is connected. And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.